When many newcomers arrive in the United States, they quickly learn about things like credit scores, taxes, mortgages, retirement accounts such as 401ks and IRAs. These financial tools are commonly discussed because they are part of the American financial system. Welcome. However, there is another financial product that many Americans use for retirement planning that newcomers often find confusing at first. Before I get into detail, hi, my name is Nick, a licensed life agent and health in the state of Texas and in multiple states. Now, let me resume. That product is called an annuity. More specifically, today we are going to talk about fixed annuities. The word fixed annuity sometimes makes people feel uncomfortable because it is not always explained clearly, and there are many opinions about them online. But when you understand what a fixed annuity actually does, it becomes much easier to see why many retirees and financial planners consider them as a part of a retirement strategy. In this discussion, I want to explain fixed annuities in simple terms for people who are new to the United States so that they can understand what they are, how they work, and why some people choose to include them in their financial planning. But first, to understand annuities, it helps to first understand the retirement challenge that exists in the United States. Many years ago, it was common for workers to receive pensions from their employers. A pension was a retirement benefit that provided a guaranteed paycheck for life after someone stopped working. In that system, companies and governments were largely responsible for providing retirement income. Over time, however, many employers began moving away from traditional pensions. Instead, workers today often rely on personal retirement accounts such as 401k plans. You have IRAs and individual investments from multiple brokerage accounts. While these accounts can grow over time through investments, they are also introduce uncertainty. Market performance can fluctuate, and retirees must decide how much money they can safely withdraw each year without running out of savings, which I've seen as a problem for a lot of clients. One of the biggest concerns people have in retirement is something called longevity risk, which simply means the risk of living longer than expected and outliving your savings. For example, there's so many baby boomers who are likely to live past the age of 80, and that's what we call longevity risk in that example. This concern is one of the reasons annuities exist in the first place. They were designed to help create predictable income streams that people can rely on during retirement. A fixed annuity, on the other hand, similar to a regular annuity, is essentially a contract between you and an insurance company. In this contract, you deposit money with the insurance company, and in return, the company provides certain guarantees according to the terms of the agreement. With a fixed annuity, the main guarantee typically involves the interest rate credited to your money. The insurance company agrees to credit your funds with a fixed or predictable rate of interest for a specific period of time. Because the interest rate is guaranteed by the insurance company, fixed annuities are generally considered more stable than investments tied directly to the stock market. And many people compare them loosely to certificates of deposits offered by banks. Although annuities are issued by insurance companies and have different features and rules. The key idea is that the money inside a fixed annuity grows at a predictable rate rather than fluctuating daily with market changes. And one important feature of fixed annuities that many people appreciate is tax-deferred growth. Tax-deferred growth means that the interest earned within the annuity is not taxed each year while it remains inside the contract. Instead, taxes are typically deferred until withdrawals are made later. So it's past in the future. This allows the money to grow and compound without annual taxation, reducing the accumulation. For individuals who are planning for retirement over many years, tax deferred growth can be an attractive feature because it allows savings to potentially grow more efficiently over time. However, it is important to remember that taxes may still apply when funds are eventually withdrawn, depending on the circumstances and tax laws in place at that time. Another reason some retirees consider fixed annuities is stability and predictability. As people approach retirement, many begin to shift their focus from aggressive growth to preserving the money they have accumulated. Market volatility can feel more stressful when someone is depending on those savings to support your lifestyle. I've seen it before. I kind of laugh at it. But yes, when the markets are shaky and their funds are low, they start to panic. Fixed annuities alternatively offer a level of predictability because the interest crediting is generally defined in advance according to the contract terms. What does that mean? For individuals who prefer stability and want to protect a proportion of their retirement savings from market swings, a fixed annuity may provide a sense of security. Some annuities also allow the policyholder to convert your savings into a stream of income payments that can last for a certain time period or even for life, depending on the structure of the annuity and the options selected. The concept of turning savings into income is one of the core reasons annuities were originally created. When people retire, their financial lives often shift from saving money to spending money. Instead of receiving regular paychecks from employment, retirees must rely on their accumulated assets and income sources, such as Social Security. Some retirees appreciate the idea of creating additional predictable income streams that can supplement those sources. In certain annuity structures, individuals can choose options that convert your annuity value into periodic payments, which is pretty fascinating and exciting. These payments can be structured in different ways depending on the policy and the choices made by the policyholder. For example, payments may be designed to last for a fixed number of years or for the lifetime of the individual. It is also important to understand that fixed annuities typically include certain rules and time commitments. Many annuities have something known as a surrender period. The surrender period is a specific number of years during which the insurance company expects the funds to remain in the contract. If large withdrawals are made during this period, surrender charges may apply. These rules exist because annuities are generally designed for medium to long-term financial planning rather than short-term savings. People who may need quick access to funds should carefully consider whether the timing of an annuity fits their financial needs. Understanding these details is important before entering into any financial contract. Now, for newcomers in the United States, the vari- the the variety how can I say this? The variety for newcomers to the United States, the variety of financial products available can sometimes feel overwhelming. Between retirement accounts, investment accounts, insurance products, and tax rules, it can take time to understand how everything fits together. Fixed annuities are just one of the many financial tools available in the American system. For some individuals, they may serve as a way to add flexibility, stability, tax deferral, and potential income options to a retirement strategy. For others, different financial tools may be more appropriate depending on their financial goals, risk tolerance, and time horizon. The key is understanding what each financial product is designed to do and how it fits into a broader financial plan. Ultimately, fixed annuities exist because many people value stability and predictability as they approach retirement. While the American system offers many opportunities for growth through investments, it introduces uncertainty that can make some retirees uncomfortable. Fixed annuities were created to provide an option that focuses more on guarantees and consistent accumulation rather than market fluctuation up and downs. So, for newcomers building your lives and financial futures in the United States, learning about these types of financial tools can be an important step in understanding how retirement planning works here. By taking the time to learn and ask questions, individuals can make more informed decisions and build financial strategies that align with your long term goals and responsibilities. If you have any questions, feel free to reach out to us. Have a great day.